All right, what is going on, everybody? I'm going to be overviewing and recapping how I was able to have another $1,000 day inside of the markets. Before I dive into it, I'm going to pop all the P&Ls and all my accounts that I took it on today and all that good stuff to call out. Today I called out two live trades, two of them. One of them was a small loss, one of them was quite a big winner. All right, and that's going to be the main lesson of this daily recap is how I made the loss small and how I made the win stand out. Okay, so diving into it, let's get off this, NVIDIA craziness off the chart here because it kind of is mixing up what we were looking at. All right, before we had all this craziness coming into NVIDIA, we had a very, very obvious, clear, structured bullish market. Why was that? It all starts from the higher time frame. Okay, it's all the logic and market structure leading into my predetermined ideas. All of the high quality model number 3 and 4s are going to come, right, A plus ones at least, from what the higher time frame is telling me. Okay, so if the higher time frame is, tipping its hand to be bullish, it's going to be very, very easy for me to find high quality A plus model number 3 and 4s and be on the right side and not be a pattern trader. All right. So this is what the higher time frame is telling me. We came down into a large discount last week. We swept internal liquidity. Boom, hits that. Creates a significant intermittent term low. Huge expansion off of that. Boom. We redeliver this imbalance. Create yet another intermittent term low. Come up off of that. All right, but here's the interesting part. We generated relatively equal highs. Worked down off of that. Left them open. And anytime I see that in a bullish market structure market, that's when I'm aggressively looking and going to find the easiest model number 3 and 4s in the market. So the higher time frame backing us bullish. Okay, the draw is bullish. Let's drop down and see what I was actually looking at. So 15-minute time frame. What I'm going to show you guys is the original loss that I took. All right. Same exact idea for both of these trades. You guys have to understand, none of the trades that I take are random. That is how I have an edge in the market, by consistently trading the same exact thing. And that's exactly what I did here today. I traded the same exact thing, but one resulted in a loss, one resulted in a big win. So let's talk about it. The first thing that I'm looking for model number 4 is a smooth trending move to the upside. And we got that right here. This is where the first trade comes into play before we get our second trade. We have an actual smooth delivering market on either the 15 or hourly chart. Okay, right here. This is that light bulb moment. Why? We have a huge run up. Once I get, like I said, a smooth delivery run up towards the draw on liquidity specifically. But instead of chasing that, I'm waiting for something very specific. What is that? This right here. Boom. Light bulb delivery in the direction of the draw, leaving behind either a 15 or hourly fair value gap. Once we do that, once again, all this stuff is so easy to spot whenever you understand higher time frame market structure, right? Which is what I briefly overviewed for you guys. We deliver that 15-minute gap. Boom. There's the first check mark. Now what do? This is when we drop down to the lower time frames and we find a time-based entry model inside of that gap. And what does that look like? Very, very simple. I wait for an old low to be swept. Boom. And once that low is swept, I can then find my systematic entry, right? Because we're accumulating more longs once we sweep out an old low inside of that 15-minute gap. Boom. Classic textbook model number 4. I can long that once we get a displacement off of that. There we go. Here is where things got interesting. We get a change in the state of delivery. Majority of the time, this is going to pan out. All right. What did I do? As soon as we got the retrace into these consecutive down candles here, that's the order block, I longed, put my stop loss at the low, just below it a little bit, held my targets right here, and my higher target was up here. And we're hit with whatever you want to call it, a Trump tweet, scam tweet, 5-second 40 handle candle, candle of death, whatever. There's no excuse. I simply got stopped out in a scenario where I was correct. So I get stopped out, and what does price do? Immediately smashes to my draw on liquidity. And this is where things get important. Okay? Because there's one of two decisions I can make at this point. I can chase, I can revenge trade, I can do further unnecessary damage, or I can simply wait and be patient for the next opportunity. Fast forward ahead, fast forward, and oh, was our full target hit? Nope. So that automatically tells me there's still opportunity on the table. So what do? I watched the market almost like a hawk, and I waited for an opportunity. Oh, I missed the original lower entry. What do we look for now? Do we have a 15-minute fair value gap form in the direction of the draw without it being met, right? Let's find out. Oh, would you look at that right there? What do you see? Right up to our Model 4 target. What's the Model 4 target? Very, very simple. This old daily buy-side liquidity high. That's the higher time frame daily draw on liquidity. All right, so that's left unfulfilled. I can still look for a valid model number 4 when it's there. Same exact thing that I talked about in this example. What do we have? Is it a smooth trending move, or is it, whipsawing around? Nope. Huge solid candle. Does it create a 15-minute gap? Yes, indeed. There we go. There's my 15-minute gap. I waited for it to tap down into it. And now that it tapped down into it, same exact thing as the last example. I can drop down, look for my 1-minute stop rate inside of the 15-minute gap. Do we have that? Yes, indeed we do. Why is the stop rate required? Because it's a continuation model. I want to be in sync where smart money is reaccumulating longs. That's where I'm going to get the highest quality continuation longs, right? Inside of this market. This gives me a true edge inside of the market because this repeats a ridiculous amount of times. Smart money is always reaccumulating longs in this manner before reaching high quality draws and liquidity. So notice how similar both of these moves are. 1-minute sell side raid. Inside of that 15-minute gap, we had an assertive run towards our draw and liquidity, and then what? Same exact thing. Same. Boom. Change in the state of delivery. Have you seen this before? Changes the state of delivery, creates a fair value gap. Boom. Nice displacement out of there. There's your long. Now we have a banger. And notice how much larger the win was than the loss. That is what you need to prioritize inside of the markets. Make the winners win big and make the losers small. Very important. All right. Now, take a step back for a moment. Oh man, this trade was not inside of a macro. Alrighty, but what did the macro do? What did the macro do? Oh, wait a minute. What's going on here? This right here, I'm shading the 1250 to 110 macro. The macro generated the low where smart money reaccumulated longs to then send us higher. So the fact that the macro did the work necessary to set up the model, light bulbs are flickering, aren't they? Makes this valid. Okay, there's one of two things that my trades are going to be based on time-wise. They're going to be based on macros either setting up the move or an entry inside of the macro. It's always time-based. It's always surrounding, every single one of my intraday trades are always surrounding the opening and the closes of the hourly candles. Very, very simple. Okay, when I'm looking to take the long here, what happens? We create a very large hourly wick. Boom. Set in that manipulation in a bullish market. So we already done a lot of severe damage to the downside. What does price do? Price comes down. Do your measurements. Respects the upper quadrant of this wick. And to me, that's a valid point to see this as the low put in on the hourly candle. Oh, PO3. What did we do? We opened. Traded below the opening. To do what? Reaccumulate longs. Where at? Holy shit, it's all coming together now, isn't it? We traded below the hourly opening to accumulate longs. Reaccumulate longs. Absorb more liquidity to keep pushing us on higher. That is the hourly intraday PO3 that I trade every single day. And it's made very, very simple through model number 4 in model number 3. By the way, for my members that have been with me for at least a month, okay, without me mentioning it, you know that this right here is a classic model number 3 entry. You missed a model number 3 entry, guess what? Half the time you'll get a model 4 like this. Boom. Beautiful. Mic drop. Enough said. If you want to see more daily recaps, reviews like this, go ahead and drop a reaction, like, whatever that is, and I'll see you guys in the next one.